All right, so today I wanted to do something a little bit different than what I normally do. I'm going to do a tutorial, for lack of a better word, on Stock Unlock. I'm sure they have done it personally, but again, I'm just going to go through my personal, like the things I like the most, what I look for when researching stocks, all that kind of stuff. First things first here, you can switch to lights and to dark. I do keep it on dark just because I think it looks better. You can also invite people. It looks like they do have a kind of a tutorial thing on the right-hand side here. Another new thing they recently added was AI stock reports, although you do have to pay extra for that. On the left-hand side here, you'll see there's the home. You have portfolios, screener, the tracker, so you can add watch lists, freeform, discounted cash flow, and then the other stuff is not really relevant. So first things first, let's get into how to search for stocks on here, all the things I look for, etc., etc. I'm going to try and keep this as brief as possible. So first things first, on the left-hand side, they have the times here. So if you want to screen by the day to see a chart based on the day, the week, the month, the year, 3-year, 5-year, and max. They also have insider transactions here, although they do have a better one in a different spot I'll look for. SEC filings, and then they have a description of the company, when it was founded, etc., etc. If you look on the right here, they'll have the analyst recommendations. So again, they'll screen by all the analysts. And again, obviously the higher the score, the better here. The average analyst rating, the low, the high, the financials, although again, there's a better tool for that. On the right here, this is just your basic information on the stock, the market cap, the industry, the earnings, the PE, the dividend, if it pays a dividend, payout ratio, price to sales, price to book, earnings yield, free cash flow yield, price to free cash flow, payout, PE, the next earnings date, the ex-dividend date or the last ex-dividend date, and then the shares outstanding. So this is the basic homepage you're going to see when you search a stock. The next thing is the insights. Now, the insights are more of a broad, generalized way of looking at a stock. You can uncover quite a bit about a stock when looking here, although you're probably going to have to dig a little bit deeper. So they set it by categories, profitability. So again, you'll have the major profitability metrics, management, stock-based compensation, return on invested capital, return on equity, and then they'll average out the score. Next one is growth. The problem with this is that it's only for the last year, I believe, or it's year to date, or maybe. So the problem with that, in my opinion, is that's not. I would rather set this as like the next 3-year or 5-year projections, because if a company if revenue is down 10% in the last quarter, I don't really care about that personally. I care about what's going to happen over the next 3-year, 5-year, 10-year period. So that's something that I might change a little bit there if it was me. Financial health, again, important stuff here. Current ratio, basically assets divided by liabilities. Shares outstanding. So again, this is another important metric. You want to know, hey, are they issuing shares? Are they buying back shares? Apple is buying back, so they're doing a good job there. Debt to EBITDA. If you look at analyst expectations, so again, this is another one. Again, this is over the next year, which is good to see. Dividend, again, they have a better page for that, although that is a good, at least bird's eye view. Valuation, again, very important here as well. You looking and understanding the valuations, because there's basically there's two secrets when it comes to buying stocks. There's two basic secrets. Number one, are you buying a good company? Obviously, that's at least to some degree open to interpretation. What's a good company? Number two is, are you buying it for a good price, or at the very least a fair price? Because there's a lot of good companies out there right now and throughout history that are very good companies, but they're very expensive. And that's very good company. Obviously, that's a great thing, but it is a red flag. Now, again, if you look at Apple here, Apple falls into this category. Good company, but they're very expensive. They're significantly above all of their historical valuations, which in layman's terms, that would suggest you probably don't want to be buying the company where it's at right now. So that's the Insights tab. That's usually the first thing I will look at, because if you want to spend a couple minutes evaluating a stock, or 5 minutes, so that's all you got, this is a pretty good way of doing it. Now, if you want to dig deeper, you're going to want to dig into the financials. Now, the financials are broken down into the income statement, the balance sheet, the cash flow statement, and the metrics. So again, this is your accounting stuff here. Now, again, some of it you kind of do need to be an accountant to understand what exactly that means. Like net interest expense, yeah, you like a layman's person, you're probably not going to understand that. Revenue, that's fairly easy to understand. Gross profits, earnings per share, shares outstanding, that's pretty easy to understand. Now again, some of this stuff you're going to have to dig a little bit deeper. So the most important things here, in my opinion, are revenue, because good companies almost always are growing revenue, although you also have to keep in mind that there's a lot of mediocre companies, there's a lot of bad companies out there that grow revenue all the time, but they're not growing earnings. So revenue in and of itself is something. Revenue growth is almost always something you'll see in a good company, but you also have to keep in mind that the underlying profitability, the profits, all that other stuff, the earnings, needs to be coming along with that. Now, if you look with Apple here, earnings are going up very nicely. They're buying back shares. Shares outstanding is another important metric I look at, especially for more mature companies. A company that's perpetually issuing shares is a red flag. Unless, the only time I would say it's not is if it's like a smaller cap, maybe a medium cap company that's still in its growth phase. You also have to keep in mind that there's a lot of companies that they might fall into that category, but they're not growing profitability, they're not growing earnings, all that stuff. There's a lot of companies out there that constantly dilute, but they never actually grow the top line underlying metrics. So that's something that's very important to understand, is that a lot of this stuff is somewhat open to interpretation. If a company is issuing shares, you really need to figure out why they are issuing shares, because usually it's a red flag, but it's not always a red flag. Balance sheet. The main thing you're going to want to look at here, at least I look at, is assets to liabilities. You want to be investing in companies that have more assets than liabilities. There's some companies that are exceptions to the rule, like certain real estate companies and stuff like that. You kind of have to borrow money to make your money. But like traditional like tech companies and most businesses, you want to have more assets than you have liabilities. Another thing, again, you can break it down by current assets, long-term assets, the amount of cash they have on the balance sheets. When you look at Apple, they have $61 billion in cash on the balance sheet. Their liabilities, 290. There's some companies out there that they will quite literally have more cash on the balance sheet than they have current liabilities. Those companies are typically good companies that you're going to want to look at investing in. Again, there's a lot of other things here that they list here that would take way too long. I don't want it to be an hour or 2 hour video. Those are the main things I look at here, is simply, is the amount of debt they have sustainable? And to some degree, that's going to be open to interpretation, because what is a sustainable amount of debt for one company is going to be radically different from a different kind of company. So you have to keep in mind the industry that you're looking at. Cash flow, again, another important metric here, because good companies are companies that grow cash flows over time. So when it comes to a lot of these numbers, you want these numbers to be growing over time. Free cash flow for most traditional stocks is probably your holy grail. This is the number you want to be growing the most. Although ideally you're going to want to break it down by free cash flow per share, or even free cash flow excluding stock-based compensation. Stock-based compensation is another metric you're going to want to keep an eye on here, because a lot of companies, especially a lot of some of these high-flying tech companies, the people that run the company enrich themselves through issuing shares and selling the shares on the open market. So one thing I'll briefly get into here is the insider transactions. If you see a company to where insiders are like constantly selling, like 80-90% of the insider transactions are sells, that's a red flag. You really want to keep an eye out for that. This going back to the financials here, the metrics, this is very important. This is one of the things I really keep a close eye on. So again, first thing here, the margins. These numbers are very important here. Operating margin, net margin, EBITDA margin, free cash flow, operating cash flow, etc., etc. These are important. You want these numbers. Again, what is a good margin for let's say a convenience store chain is going to be a lot different than a software company. So you also have to keep in mind that just because a number is 20%, for one kind of company that might be amazing, for another company that might be mediocre, for another kind of company that might be actually kind of bad. So you have to keep in mind what is the average for the industry of the company that I'm looking at. These are the historical valuations. That's important to read. Return on equity, return on invested capital. Again, these are also very important numbers. Payout ratio, stock-based compensation, free cash flow per share. Again, these numbers here are pretty much the holy grail. You want these numbers to constantly be going up. With Apple, that is the case. Current ratio, again, you want that number to be higher. Any number below like 1, roughly, is concerning for most companies. So again, that is basically that. KPI, again, this is breaking it down even further, like the revenue and a lot of these metrics. This is basically brand new. They haven't had this around for very long, so I haven't really played around with it, but it is fairly self-explanatory. It basically just breaks down its revenue, its income, based on regions and based on different kinds of products, right? For Apple, it's the iPhone, the Mac, the iPad, etc., etc. So that's good to see because honestly, like, you want your revenue to be growing the most in the areas that are expected to have the most growth. So that's a good metric to have for sure. The dividend metric here, this is one I also look at a lot because I really like dividend companies. So this one's pretty self-explanatory here. Number one is the historical dividend yield, and then you have the historical yield on cost. This is very important because it'll show you, let's say you bought Apple April 29th of 2015, your yield would be 3.1%. And the reason why this is important is because for companies that are growing their dividend over time, your yield on cost is going to be going up, assuming the share price goes up. And I like this because it's a good barometer of if they maintain the levels of growth that they've had over the last decade, what is your yield on cost going to be in a decade, for example. So that's very important to see. This is also very important here. It'll show the historical returns even with dividends compared to the S&P, right? Because if you're buying individual stocks, you want your individual stock to be outperforming the S&P. Now again, historical performance doesn't necessarily equate to future performance, but it's a good thing to consider at the very least. So the dividend here, it'll show you your current yield, dividend per share, and then it'll show you the 3-year, the 5-year, and the 10-year growth rate. This is very important because if you're buying a company that pays a dividend, you want them to be growing that dividend over time, because it wouldn't make sense to buy a company that pays a dividend that, I mean, in some cases it would be okay, but if a company's not growing its dividend over time, in my opinion, that's a little bit of a red flag. And then it'll also show you your payout ratio based on earnings and free cash flow, which is also important because if the payout ratio is very high, it could signal a potential dividend cut, or at the very least, the company's not going to be able to grow its dividend as fast. So that's something to keep in mind and watch very closely. So that is basically evaluating a stock in a nutshell. For me, again, if it pays a dividend, I'm looking at the dividend, I'm looking at its profitability, I'm looking at revenue growth, earnings growth, free cash flow growth. I'm looking, is it issuing shares? And then I'm looking at the valuation. Like, it's fairly straightforward. On top of that, you're going to want to check its go to the freeform tool here and say, okay, well, this will show you a little bit more in depth the historical free cash flow, operating cash flow, valuations. You can add revenue. You can add numerous things here. Basically, to do that, you're just going to go into this. Actually, no, you're going to go into this one. You can type it, or you can just search for it and adjust as needed. There's, again, price to a million different things: stock-based compensation, return on equity, return on invested capital, operating margin, your margins, all those kind of things, free cash flow, you name it. There's more things than I could go over. It would be an entire video just going off those things. When you look at Apple here, you'll notice something pretty clear. Its valuation has grown pretty consistently over time. This is a good way to look at things, because another important thing you want to look at when you're buying stocks is, are they growing based on organic growth, or is the share price growing because people are simply paying more for existing levels of earnings? And when you look at Apple here, most of the growth is coming from people simply just paying more for existing levels of earnings. So that's something that's definitely a little bit of a red flag if you were to buy the shares based on current valuations. So this is also important because it'll show you the average valuation going back 10 years, 20 years, or 5 years, whatever number you want to go. So if you look at Apple, the average price to free cash flow over the last decade is 20.75. It's currently at 38. So based on those numbers, it is extremely expensive where it's currently at. Even if you go back 5 years, average is 27. So it's still very expensive. So this is a very good tool to play around with, because remember I mentioned that you want to make sure when you're buying stocks that they're a good company and you're buying them for a good price. This tool right here will help you know, am I buying it for a good price? The next thing to bring up here is the discounted cash flow calculator. This will also do something similar in that you can basically play around with it and type in certain numbers to say, hey, but let's just do it right here, just for sake of arguments here. So I'm going to just set it to maybe 2%, dividend growth, maybe 5%. Average price of free cash flow, let's say 21. That's the last, maybe 25, because I think it could grow a little faster. So this is basically, if we did this with Apple here, let's say they'll grow free cash flow 8%, they'll buy back 3% of shares, they'll grow the dividend. So basically what I'm saying here is, you're going to want to figure out what is the rough estimate to how this company is going to grow earnings or free cash flow. Is it going to buy back shares? And if so, what percentage? How much is it going to grow its dividend? And what is the price ratio it's going to trade for? You can adjust this based on 3 years, 5 years, 10 years, based on free cash flow and a bunch of different metrics. And just look at it and see, hey, if that's the case, the fair value of Apple's 192. It's currently at 234. So this is another good tool to use to figure out, am I paying a fair price for the company? Whenever I'm looking at buying a stock, I will always run it through something like this, and then I'll always run it through the freeform tool just to get an accurate estimate on growth, on valuation, etc., etc. The last thing I'll bring up here is, actually there's two other things. There's a screener, which again, there's a million different metrics you can use here. That's personal preference. You can do it based on valuation, based on margin, based on revenue or other earnings metrics. And then you can also do it based on insight scores, which is a little bit different, but is also good to have. You can do it based on home country, market cap, exchanges, and then you can separate it down by industry. One thing that they don't have here, at least explicitly, is they don't have it based on sector, which I would really like. Some of them they kind of do, like banking, financials. You can kind of add it up. I wish they could do it. I wish they could do it based on subsector or sector, because that's just me. I like looking through different sectors, but again, not necessarily the biggest deal. Again, this is personal preference, what you want to screen for. There's a million different ways to screen stocks, so that's going to be something that you're going to have to play around with. So anyway, the last thing here is the portfolios tab. Now there's two ways of doing this. You can either add it manually or you can link a portfolio. The problem is they don't have a lot of brokerages. The big American ones, I think they have pretty much all of them. The Canadian ones, I know they have Wealthsimple and Questrade, but they don't have interactive brokers, which honestly worldwide is probably the most popular one. So I'm kind of surprised they don't have it. But again, not necessarily at the end of the world. So when it comes to the portfolios tab, there's a lot of different things. You can create a portfolio. It'll show you your back test. So again, you can do that. It'll show you your current valuation of it. And then you can look at your positions here, and then you can update it based on percentage of the portfolio, gain, loss, actual dollar amount, price, shares, insight score, etc., etc. And then if you want to look at other things, again, they'll show you your insights breakdown, which is good to see. It'll show you every one of your stocks as well. If you look at the breakdowns here as well, it'll show you based on industry. This is just based on companies, your percentage of all your companies. It'll show you, break it down by country, currency, and then dividends tab is also important to see here because it'll show you your next 12 months estimated dividend. It'll show you your forward rate and your yield on cost. This is important because, again, yield on cost is different than the actual dividend rate because yield on cost is your yield based on the price of the shares the day you bought them, not based on the current yield. It'll show you yearly, hourly, and monthly income, daily as well as hourly. And then the last thing here, it'll show you the activity, which is basically you can do it based on dividends, based on cash if you're doing that, and then insider trades. So again, it'll show you insiders, what they're doing, etc., etc. So again, that is Stock Unlock. Obviously, you could dig a lot deeper, but again, I'm already at 22 minutes here. I think that's long enough. Any questions, let me know. If not, I hope to like, comment, subscribe, all that good stuff, and stay tuned for more.